What's going on, guys? Bexio back, and today we had a brand new video on the stock market and being bullish instead of bearish because so many people are bearish. So many people are making, clickbait kind of thumbnail things because fear gets clicks. But this time, let's be a little bit bullish, try and find the positives in the market because there really are some pretty good positives if you are looking longer term and not sitting here and trying to trade day to day. If you're trading, who knows? I mean, that is a lot of luck has to go on your side there. But if you're looking long term, a lot of things can be shaping up to be cleared up and actually put stock market in a better place than it is right now. But before we get into that, if you are not subscribed, make sure to smash that sub button because we're on the road to 1,000 subscribers. But let's jump right into the S&P 500. So the main thing of the market that everyone is going to look at, this is basically the market. When somebody says the market, it's the S&P 500. But recently, we had the massive, really big recovery from the drop here, and the tranche, the bottom, all the way up to the top was a sharp, great recovery. And people were saying, bubble, 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 it's gonna pop. This is the worst thing ever. The everything bubble is coming. And they've only been saying that every single year since, 2 decades ago. But if you look at this, if you measure from the bottom here, it does look like it went a little parabolic for an index to go up this almost 100 or over 100%. This is 200 to 441 is the top. So over doubling in just about a year's period. That's a lot. That's a really explosive growth here, and you can see kind of the lines for the top that I drew later on here, where this is what the S&P was interacting with. It was kind of would have dips, would come back up to this line and fight the line, have another dip, but it would ultimately come back up. But we broke away from that pattern recently with obviously all of the things going on with Russia, with Ukraine, with geopolitics, inflation, the Fed getting harsher on it. So a lot of things came out and we saw this massive pull down, and we bounced off this new line here that I just put in. And if you zoom out and go back to around this period, so this would be January 2019. So this is the bottom of whatever dip this was from. And you draw from there, seeing how this is basically the mean. If you even went out further, it would be a little bit lower down, but 2019, pretty decent point to go back in time to, what is it, 3 years ago at this point, and seeing that this kind of was the uptrend here, and this was the massive news event, the crash that happened, and the recovery was sharp. But falling down, it feels like we're falling and it's such a bad time, but it's really not that terrible because we're still on this mean of this uptrend here from 2019. So it's not that bad. We even really bounced off of it. So as long as we're riding this line, and if something crazy happens, it's completely possible for this to continue to have a little bit fall underneath, because obviously there's other things that the market's really fearful of right now and uncertain, and that's going to push people to overreact. That's what always happens in the market. People overreact. So to bad news, the market overreacts because it's planning for the worst. To good news, the market could overreact because it's planning for the best. So it just happens either way. And right now, when you zoom out, it doesn't look that bad. People say the everything bubble popping, oh my god, this is terrible up here. But I mean, just a year ago, this was, steady upcline. You go back even 3 years ago, like, it's still massively up in this period of time, and just going back to this kind of mean. So nothing crazy really going on. And we all know the Russia things happening. People saying Russia, people there saying they're not going to invade, other people saying they are going to invade. No one knows what's happening. That's the worst thing for the market because it wants to have certainty. Any uncertainty is just going to fuel volatility and downside moves. But here, I mean, we had a meeting or some sort of meeting set up between Biden and Putin, so we'll see how that actually goes. But maybe this can clear up some things for the market. And just talking about a Russian invasion of Ukraine, what it means for the stock market, everything else, and it actually might surprise you that it's not even really that bad. So when you go down You see, obviously, stocks and financial markets reacting to headlines. That's what's been happening. Obviously, the headlines are the biggest things. That's what people see. Rarely do people read the articles and things. So the headlines bolster moves, and that is what has been happening. The big thing that would be drastic for everything and just would make things so much worse in financial markets and even in inflation and things is this right here, the focus on energy prices. So analysts warning that crude oil remains likely to shoot above $100 a barrel. So this is obviously not great news. This would push inflation up further, add to the Fed stuff, and kind of push more uncertainty in the market, but it would be short-term stuff. So as long as you have a long time horizon, you're not looking at day-to-day kind of moves and betting on long-term stuff, then these things could just create better buying opportunities. Short term, they could create problems if you're trying to trade in and out of stuff. And then this quote just talking about they remain optimistic diplomatic resolution and or de-escalation will ultimately result. This is not certainty with tensions high. A favorable outcome would reduce the current geopolitical risk premium built into oil prices. So that's why they're up so much, or not even up so much, but why they're up a little bit more recently is the premium put into it because of all of these things going on. And then closer to an $80 year's end. If we look at the oil market, we can see that it is currently at $93.95, which is already crazy. You can see the insane increase from the beginning of the year. From it was around 60 to $65 and just skyrockets to this 93 here. And people talking about being over $100 per barrel. If you look at this line being the 100 right here, that's only happened for a few short periods during 2011. So around 2011 to 2014, there was times where oil was relatively high, peaked above 100 for a bit, but it kind of sustained above that $80 level. And then also again, 140 in 2008. So it hasn't really been over 100 that much. And we get problems with obviously geopolitical things. This can impact inflation, which can impact how the Fed reacts to inflation, which can impact the market. So it's just the volatility is something that seems to not be going anywhere anytime soon. We need this Russia thing sorted out. We need this oil prices kind of sorted out because it's going to push inflation up as well with the prices skyrocketing and how the Fed reacts to all of this stuff. If inflation continues to just get worse and worse after a year where it was already pretty bad, that starts to get into a really bad situation and could push the Fed to start making different decisions and start actually going after inflation, which would be what the market's not planning for, be more uncertainty. So the short term, even short term could mean 6 months. That could be something where we have to deal with all this stuff for the next 6 months to a year even. And it could be a bad year or a negative year in the stock market, but that doesn't mean that there's so many problems that you should just stay away, because staying away from the market is not the right answer. And we can see that with something like this kind of chart where you have these 5 different make-believe people who are sitting in investing, wondering what to do. So one, you have someone who has perfect timing. They always buy the bottom. They always have perfect timing on the investments, and they end up making $151,000. And this is off of you taking each year. Once you receive cash, you invest in $2,000 in the market first trading of the year. So the same people. So this is $2,000 a year over a sustained period of time. So 20 years. So a long period of time, $2,000 a year, nothing crazy. But when you look at perfect timing, it's $151,000. If you look at invest immediately, so someone who just on the first trading day of the year, they just put all their money in, don't care what the market does, 135,000. Dollar cost averaging is 134,000. So basically the same here as investing immediately, because it would be a little bit different if it was lump sum immediately. If it was like 20 grand instead of 2 grand, and then, or 20 grand spread out across the year, you'd get a little bit different. They would probably have a higher result. But this just shows timing the market doesn't really pay off, because perfect timing is impossible, and it's only not even 20 grand higher than just investing immediately or dollar cost averaging. And even if you have bad timing, the worst timing, you buy the top every single time and you just let it sit there and ride it out, you still make 100 or have $121,000 after 20 years of just $2,000 a year. Or if you just stayed in cash, it would be 44,000. So that's why you don't want to try and time the market, because it's not worth it. It's not something that you can do efficiently enough, even if you got it perfect every single time, which is nearly impossible. You still don't even get that much of an advantage over someone who just dollar cost average or just invests immediately and lets it ride. And not to mention, if you are trying to time the market, there will always be a reason not to be in the market. There will always be something looming, something that could cause a problem and make you want to sit out. So it's better to just dollar cost average, buy the dips, or continue buying consistently, and just ignoring it and letting it do its thing and letting it ride out over time. Because even timing the market is something that doesn't reward you all that much. So we know the stock market is not in a terrible place. Timing it's not the thing to do. Dollar cost average is the best approach to just investing in general, and sitting in cash is the worst thing you could do for a long period of time. But that's going to do it for this video. As always, don't forget to smash the like button and subscribe. We're on the road to 1,000 subscribers. I'll see you guys in my next video.